Hello, everyone, and welcome back to Markets in 2 Minutes. My name is Dmitriy Katsnelson, and I'm happy to have you all here for the first Market in 2 Minutes of 2022. And today's topic is going to be the Fed and interest rates, obviously a topic that we'll be touching on several times, I'm sure, in 2022. And point you to the headline, which is markets are pricing in at least 3 Fed hikes in 2022 and potentially 4 in 2023. So we haven't been here in a few years where the markets were finally expecting interest rates to go up at the same time that the Fed was signaling that interest rates were going to go up. So this is obviously raising a fair amount of questions to what happens with bonds. And in this chart here, we wanted to just show you what happens to the Fed fund rates and bond yields over time. In blue, you see the Fed funds rate, and it's obviously been flatlined here for a couple of years. And in yellow, you see the yield to worst, or effectively the expected yield on core bonds using the Barclays index. And you can see here that the yellow line tends to start rising before the Fed funds rate starts to rise. And that's basically just the market pricing in higher interest rates. And we're in the same place today. So obviously the markets are pricing in those rates. So the immediate response is, hey, rising interest rates, that's effectively bad for my bonds. And the answer is yes, in the short term, but not for the long haul. And this is why we point you to the second slide here. This is a slide showing you, and we're using munis here as a proxy, but we can use core bonds, high yield, others as proxies as well. Just showing you what happens to your portfolio of bonds if rates rise by 1% versus rates falling by 1%. And obviously in the first year, you would rather have rates decline because you get that immediate pop in prices, but thereafter you're clipping very, very little. Whereas if rates rise, you get that initial pain, but after year 5 or 6, you're now ahead of the falling rate environment. And beyond that, you're clipping a much, much higher coupon. So this is something we've touched on before, and we'll touch on again this year as interest rates rise and hopefully rise across the curve, not just the Fed funds rate, in that as a long-term bond investor, you actually want higher interest rates. There's that immediate pain, but over the long haul, you get to clip that coupon over the next 5, 10, 15, 20 years. So I want to bring that to your attention. We'll have different ways of saying this coming year as we see how the game plan for the Fed ultimately plays out. But to start the year, we wanted to show you what's happening with the Fed funds rate, with bonds, and how we think about it going forward. So we very much appreciate you guys joining us in this first Markets in 2 Minutes of 2022, and we very much hope that this year treats you better than the last. Thanks again, and take care.